Hey everybody, we're live. It's Rob Keens of goldsilverpros.com bringing you Tuesday's edition of Cowboy Metals Live. Welcome everybody to the program. We're going to let everybody know we're in and give it a couple minutes before we get started on the content. Thank you everybody for joining. YouTube sounds like sound is good. Got our sound check. Thank you everybody for joining. The title of today's presentation, we're going to talk about the yield curve inverting and why this is big news if you own gold and silver and if you're planning for your budget and your finance and your positions. We'll also talk about how the banks have now gone long silver and are positioning in both the precious metals, silver and gold, for the managed money, the hedge funds and those types to take the fall when the market turns around, which is telling me both things, which are telling me the gold and silver markets are about to go on a major bull cycle mode. Thank you everybody for joining. We have a poll up, guys. And the poll is a simple question. Recession is right around the corner. Do you either agree or disagree to that? Let us know by posting or voting in the poll, and we'll take a look at it. So far, 97% are agreed. It's only 31 votes. That's about half the people in. Remember, super chats are open. If you want to grab my attention with a comment or a question, I'll be sure to answer it. I'll do my best to go through the regular chat as well, although no guarantees if you don't get it up on super chat. So a lot of big news going on today. I'm going to talk about two things in which I think are the most bullish for the precious metals and why people should not worry so much. Yeah, the prices are down. Gold's in the 1,700 range. Silver, I think, is an $18 range. It looks horrible. Of course, if you've been following my channel the last few weeks, I've explained why it just has to do with the derivative trading and not the physical metals. I think we've made that case, and there's something else that I want to talk about today from a more fundamental perspective and a trading perspective is why I think gold and silver are about to launch. And we're going to start by looking at the Commitment of Traders report. This comes from the CFTC. You'll notice that we're right here on the CFTC website, cftc.gov. And we're looking at the July 12th, which is the most recently available Commitment of Traders report. The next one should be due out in the next couple of days. There are two huge changes on the Commitment of Traders report since I last went over it. Again, two huge changes, and I'm going to go over what those are right now. The first change is basically that the bullion banks who have been net short physical silver for as long as I can remember, at least 99.9% of the time have gone net long. So as we come down here to silver, I'm going to highlight that for you. This is the rough, call it like a dot matrix printer report or an old school printable report or CSV, comma separated value report that you would get on old computer systems. CFTC doesn't have an interactive tool for positioning in the futures markets I'm aware of, so we're just going to read the report they give. Again, this is silver. And if you see here, this is what I want you guys to pay attention to. I want you to pay attention to all positions, but specifically on this line where we go managed money and swap dealers. You guys know the swap dealers are almost always the highest percentage short. They've gone net long. So the way to read this is they've got 46,173 contracts in silver long, 37,013 short. And that means they are net long by about 9,000 contracts. They have not been this far net long by 9,000 contracts in a very, very long time. And you can see here the activity in the change column. They've dropped 1,417 in the previous week. They dropped or got rid of 1,417 short contracts and added 305 long. And you can see they're spreading long right now to the 954 contracts. You look at the managed money, which is always on the opposite side of the positions from the bullion banks, and they are the patsy, if you will, always with the bullion banks. They have now gone net short. So if you look at silver, they're net short 47,543 contracts and net long 37,095. So because the managed money is net short, well, we'll expect the market to turn, the swap dealers to make the money now on the long side of the trade. But what's most interesting here is what I want you to take a look at. Managed money is net short 47,543 contracts. And the swap dealers are now net long 46,173, almost an identical number within about 1,200 contracts of each other. The managed money is now net long on silver 37,000 contracts. The swap dealers net short 37,000. So it appears as though the swap dealers are getting out of the short position and going long and just transferring almost one for one all of their short futures positions on COMEX with the managed money. Now, we have to see how long this lasts, because my thought is the positioning will come and the swap dealers will drop most of their, especially their house positions short by the time that the inflection comes in silver and starts to rise again and stay risen. And so we want to see this number right here, the difference between these two numbers, that the swap dealers are going to stay net long and continue to go net long for a period of time. And then if they do, I think that's a big indicator of a bull market coming in silver, a massive bull market. And I think this is the most important thing to look at. And again, it's all on healthy open interest, 142,000 contracts of open interest. So it's a nice, healthy trade in silver. This isn't, you know, a move in a small month or a down month. This is a move leading up to what is going to be a big contract month for silver and the ability to take some delivery as well. So this position comes ahead of a big silver month. Now we want to talk about gold. Gold, something interesting has happened there. It's not as far along, I think, in the net positioning going long by the bullion banks as silver is, but I think it's going to be pretty interesting to see that the same level of positioning is going on there as well. So again, gold, if you look at the reportable position, swap dealers are still 198,634 contracts short of 100-ounce gold, and they're only 88,000 contracts long. So they're still net short by about 109 or 110,000 contracts. One would say, yeah, Rob, they're still way short. Yes, but look at the movement. They dumped 16,000. This is the biggest move I've seen the swap dealers have in gold out of their short position in a long time. Almost 17,000 contracts of 100-ounce gold were dropped in the last week. 17,000, and then they took additional 7 or 19 long. So it's a net change of over 17,000 contracts to the long side. They're definitely positioned very quickly and very hard to the long side in gold, even though net short, and even though they have the largest net short position, 36.6% of all net short positions are still held by the bullion banks. This has been a very big change. If we look at the managed money, they have dropped 11,803 longs and have added 11,364 shorts, thereby executing about 23,000 contracts in the last week to the long side. So they obviously have been the ones to take over the drop in short positions from the swap dealers. Also, the other reportables are dropping some of their longs as well, although just a minuscule amount, and they still hold the longest position of longs. The other reportables, these are the family offices, wealthy individuals, are the longest as a category bullish in gold, and they tend to be some of the smart money and people that could profit from this trade. And as the swap dealers go longer gold, they're now 16.6%. You can see the market shifting about the swap dealers and the other reportables being aligned and going long gold. And I think that's another extremely bullish signal. I wanted to look at it visually on bar charts. Bar charts has a nice visual. If you go here and just put your cursor over, you can see up here, there will be a table. So look at that table. And if you look at COT DIS parentheses S, that is the swap dealer. And you notice that they're now net long as of the latest COT report as shown here on the bar chart. And they're in green. So if you look at what's happened, they were net short in green here and then moved themselves up to a net long position. Whereas the blue, which is the hedge funds and money managed money account, has gone net short. So you can see how the swap dealers have passed off their short positions in silver over to the managed money. Same thing in gold. Their green category is also the managed money, and they're almost, are they moving up in gold? They're also being aggressive and dropping shorts, and they're dropping them to the blue line, which is coming down here to equilibrium or to zero. They're dropping them to the managed money. So you can see pretty quickly who are going to be the patsies in this poker trade. As you said, the poker table, the bullion banks are going to win by going net long, and the managed money is going to take it in the shorts. You may wonder how this can always be the case, and I'm going to explain that. The managed money is included in a lot of different funds, and it's usually a small percentage of the fund's holding. And since the managed money market, the bond and stock markets are much bigger, and that pool of resources that could potentially go into precious metals is so much bigger than the precious metals, it's very easy for the bullion banks to take a very small percentage of that managed money, okay, the ETF and mutual fund type money, and slide that over to precious metals and make those guys take losses before they capitulate. Why? Because it's such a small percentage of the fund. So if you take a 10% loss on your precious metals position over a week or 2 week period of time, but you're only positioned 0.5% overall of your managed money into the gold and silver trade, which is about what it is right now, it doesn't affect your overall portfolio. So that's how the bullion banks can trade against the larger market in precious metals in the futures and continue to make money off of them and continue to make them passies, because it's such a small precious metals market when compared with who they're trading against. So they're taking cash from this big market into this small market, and that's how they're able to do it. So that explains how the bullion banks always beat the managed money, how the managed money never capitulates and continues to go on this side of the trade, and how the bullion banks are able to convince them to do it. I can only imagine the research going to the managed money and the hedge funds as to why they should be dumping precious metals right now, while the bullion banks reposition their entire portfolio, both their house and client portfolios, into going long. You know who's going to win that trade is going to be the bullion banks, but that's how it works. All right, taking a bit of a break before we go on to the next segment. This is Resetting, July 19, 2022, Cowboy Metals live stream. We broadcast from the great state of Texas, and we take no BS. We tell you the truth, and we're based upon data, and we know you guys like that. 152 in the stream right now. We have a poll up. The poll question is recession right around the corner? 94% of you out of 67 votes are saying agreed. 6% are saying disagreed. I think that's a pretty easy one, given all the indicators we give you guys. But in any case, just wanted to throw it out there. Steve Ross comes in with the question. Thank you, Steve Ross. Is there a European debt crisis? How will that affect gold and silver? I do believe that there is. There's a nice article out talking about how the European Central Bank cannot tighten as much as the Fed right now. And I'm going to talk about the Fed tightening here in a minute. They've announced their next increase already, or their, I should say, foreshadowing the next increase already. The Fed's going to tighten really hard because the European Central Bank and the euro is in more trouble than the dollar and the Federal Reserve Central Bank. They had already gone negative interest rates. I think it was up to like 15 or 16 trillion in negative interest rate debt in the last few years in the European Union, most of that in the European Union, some of it other parts of the world. And so they cannot raise as much because it would crash their system. So I do think Europe is in a crisis right now, and the European Central Bank is stuck between a rock and a hard place. And 12 or 13 years ago, when I first started writing about this, I said, I think Europe would be the first to fall, and I'm probably going to end up being correct on that prediction. I also think Japan could be there too. I think either Japan or Europe could go first, and I think that there are debt crises in both areas. And the thing to worry about with Japan and Europe specifically, they'll both hold a lot of U.S. debt. Japan is one of the largest holders of U.S. debt. So if they start dumping U.S. debt, that could exacerbate problems in the dollar as they come under their own debt crisis and currency crisis, which I think both of those currencies will as well. And both of those central banks will continue to come under extreme stress. Thank you, Steve Ross Holmes, for the contribution and the question. We appreciate it. All right. And it was a really good one and a really timely one. I'm glad you asked. So we're going to back to the program. I last showed you the COMEX data and why I think it's extremely bullish. I want to go back and I want to suppose why the bullion banks are doing what they're doing now. What are they doing right now? They're going net long in gold and silver. They're still net short in gold, but very quickly moving positions and dumping into managed money. We showed that. And in silver, they're now net long 46,000 contracts to 37 by about 9,000 contracts. And they've, again, gotten the managed money to be their patsies on the other side of that trade. Why would they possibly be going net long? Well, as you can see from a presentation I showed earlier, this is page 35 of the Office of the Comptroller of the Currencies report. This is the quarterly report on bank trading and derivative activities, first quarter 2022. And I wanted to show you what they have in this report because it's very, very interesting. We're going to go back to page 35, and we're just going to make some high-octane speculation, if you will. Who are the four big banks that control all the derivatives in the United States markets, precious metals and or otherwise? That would include Bank of America, JP Morgan Chase, Citibank, and Goldman Sachs. It's all right here. JP Morgan, Bank of America, Citibank, and Goldman Sachs here in red. And you can see the numbers down here in this table. The Office of the Comptroller of the Currency knows where these banks are trading, and these four banks dominate derivatives. So if there's any chance for a default in the derivatives or a sea change of risk in the derivatives, it would show up in the Office of the Comptroller of the Currency report. Well, guess what? It has done just that. I'm going to talk about value at risk here for a moment. It's defined in the report as the following. You guys stick with me while I do this. I'm going to give you a little info. It's going to be very dictionary-ish here for a second, but I'm going to explain to you why this is very, very important for you. Value at risk, as defined by the Office of the Comptroller of the Currency, is banks primarily control market risk in trading operations by establishing limits against potential losses. Banks use value at risk to quantify the maximum expected loss over a specified time period and at a certain confidence level under relevant market conditions. Banks subject to the market risk capital rule, 12 CFR 3, which all the big four ones would be, are required to report their value at risk-based measures. The VAR measurement is calculated daily using a one-tailed and 99% confidence level. So what happens is the the big banks every single day report to the OCC what their value at risk is. What is their value at risk? The risk of the market of their trading positions, in a nutshell. So when we see that go up or down, what that essentially tells us is the banking system's more at risk of collapse or less at risk of collapse. That's what value at risk is. Okay, now that we have that clear, value at risk shows either the risk of the banking system collapse and derivatives going up or down. And of course, if the collapse in derivatives comes, that's going to affect the entire banking system and take down a lot of these big banks as well, depending on the scale and the severity of that collapse in derivatives. But it's measured in something called value at risk. Okay, so we got that. So you can see JP Morgan Chase and Goldman Sachs in Citibank and Bank of America's value at risk. Bank of America has the highest at 192 billion. JP Morgan has the highest, 280 billion. Bank of America second, 192 billion. Citibank 165 billion and Goldman Sachs 49 billion. And so we want to see, however, the trend is the value at risk going up or down for these guys. And if you go to the very end of this report, you get this nice little chart, average 60-day value at risk as reported by the banks. The two banks that have seen the strongest uptick since COVID are in green and red, JP Morgan Chase in green and Goldman Sachs in red. You can see these numbers spiking. Now it spiked around the COVID pandemic, came down and have gone right back up. Why is that? It's because, ladies and gentlemen, the market is changing. So I'm going to explain this to you in common sense English the best that I can over the next couple of minutes. Sound check is good. 200 of you guys are in. Thank you for joining. Value at risk and derivative position means the banks are seeing more potential risk at a 99% confidence level, meaning they're 99% confident, okay, that this is their potential value at risk loss for derivatives in today's environment, not including we go into another mortgage crisis or liquidity freeze, repo market issue. I'm just talking about right now, today, given today's market conditions, as of the end of the first quarter, actually. And this is going to be worse because the stock market and bond markets are continuing to melt. But within the last 60 days of this report, JP Morgan and Goldman Sachs are seeing extreme levels of value at risk, meaning their derivatives positions are working against them. Why is that? Because the tide is turning in the market. Why? We've ended the 12-year run in stocks. We've ended the 40-year bull run in bonds. We have tremendous debt. We have banks talking about, central banks talking about CBDCs. We have people talking about the end of the currencies, even though the dollar is doing well relative to the other currencies, they're all burning. Okay, the dollar is just burning a little slower. The euros come under extreme risk. And so the market has changed. Bitcoin has crashed, crypto complex has crashed. Gold and silver have retraced a little bit, even though they're still doing better than the other assets because they're true value assets. Remember the bottom of Exter's pyramid. But what's happening is we're having a rotation in risk. Where's the risk now? It's in the previously popular investments. And so the derivative positions that these banks had that they held that were in that market have to then change, and the risk is going to go up until they can get them changed. They're going to have more interest rate risk. That's a type of derivative that's in the OCC report. They're going to have more debt risk. That's a type of derivative. What about the mortgage market? What about commercial real estate? You know, what about defaults on auto loans, things like that? All the derivatives built upon the economy are now at risk. That's why the value at risk has gone up. Now, here's the high octane speculation. I wonder if we go back and look at the COT report, that value at risk number was going up. We're going to go back to the value at risk for JP Morgan and for Goldman Sachs, which both participate in the precious metal derivatives. Maybe that risk had gone back up again. And that's why they decided to change their positions in gold and silver. That's why that they dropped. If you go to silver, while they dropped 1,400 of their shorts and added 305 longs and are now net long in silver, and while they're quickly moving to go net long in gold, dropping 16,000 of their shorts. The swap dealers are repositioning. Now, it could be that there's risks not only in the precious metals derivative markets, but in the rest of the derivatives. What about interest rate derivatives? What about derivatives on, you know, all these other markets that are now coming under pressure? But I think precious metals was one of them. And I think as we look at all of that data, what we're figuring out is the bullion banks are starting to get in the hot water, and they had to rotate. They're not only having to rotate in precious metals, they're going to have to rotate in the bond and the stock markets. So now that the banks are rotating, they have tremendous capital that they're managing for their clients and for their house accounts. We're talking trillions of dollars worth of capital. If you look at all the banks, all the big banks put together, they're going to have to start rotating their trade. And what's going to happen is they're going to sell certain things and they're going to buy other things. And that's going to shape the next bull market. And I think they're positioning, especially we see it on the COT report, is that they're expecting bull market in gold and silver. And the banks are some of the smartest money out there because they have all that trade data and they have all that client and they know how people are positioning. But the banks also follow the economy. And the banks have started to say, JP Morgan, Goldman Sachs in particular, because you saw that value at risk come up. You saw at the same time all these articles coming out from JP Morgan and Goldman Sachs predicting the next big crash. And I think Bank of America has also predicted that the Fed is going to have to roll back their tightening strategy by as early as 2023, sometime early second half 2023. So the banks follow the economy. They know what's going on, and that's why they're rotating. And I think that's what we're seeing right now. And I think it's setting up for the next big market in the precious metals. But I think there's a market reason for that as well. So this is technical data on the COMEX that I just went through explaining, and technical data on the OCC report that I went through explaining what the risk is and how they're rotating. And also, there's only 4 of them, remember, that control the market. They control all the derivatives, not just PMs. They're rotating at the same time in and around a lot of these, okay? And it looks like they're setting up for a big change in the financial system to go long precious metals and to go net short in some of these other things. The other thing that I think that they're saying is the yield curve inversion. What's a yield curve inversion? A yield curve inversion is when shorter term debt, and the benchmark for shorter term is 2-year US Treasuries, has a higher interest rate than longer term debt, and the benchmark for that measure is 10-year US Treasuries. So the Fed tracks this, and other people track this as well, the 10 minus a 2-year constant rate of maturity, meaning the 10-year should always have a higher yield than the 2-year because it's longer dated out. Longer means less certainty, means more risk, means you get paid more to take on that debt. Well, when that inverts, it means people think that short term, there's more risk than long term, meaning we're about to hit a recession. This is the best recession indicator that's out there right now in terms of a single indicator. When this inverts, when the 2-year gets higher yield or costs more than the 10-year for the issuer, that means there's a recession coming. All of the traders in this massive market, one of the biggest markets in the world, are expecting a recession to come, and it predicts recessions. And if you go out to max on this chart, the gray lines are recession. You see every time we have a yield curve inversion, recession, yield curve inversion, recession, yield curve inversion, recession, yield curve inversion, recession, recession. We've got another inversion here. It's inverted and stayed down for almost 2 weeks. That is an official yield curve inversion for sure. And I waited to call this until basically it had stayed inverted for 2 weeks. And I'm going to go to a chart dating back to July 5th. It's now July 19th. That's exactly 2 weeks. This thing has stayed inverted. So I'm calling the trend. We're going to have an oncoming recession. Not only that, but the Fed officials, according to the Wall Street Journal, in this article that came out July 17th, 2 days ago, Fed officials preparing to lift interest rates by another 0.75 percentage point hike at the end of this month. Okay, so at the end of this month, another 3/4 point hike in federal funds rate. We've seen what the existing 3/4 and 1/2 point hike so far earlier this year have done to the market already. So the Fed is putting the brakes on the liquidity in the system. They're tightening. At the same time, it looks like we're heading to a recession. At the same time that the derivative market comes under extreme pressure for 2 of the 4 biggest, and they start to reposition in the precious metals and some of the other derivatives complex. So the idea is that as you look at the positioning by the bullion banks, the smart money really in this market, they're going long for the next precious metals bull. And so that would seem to indicate me, now that they're going net long in both gold and silver, that we're at or near the bottom of gold and silver pricing. It could come down a little bit more because we still have some room for the bullion banks to go net long in gold. They've already gone net long in silver, but not net long in gold. So we may have some time before gold and silver have bottomed out, but I think we're right there. We're right there at the bottom. Maybe go down a few more dollars, a couple more percentage points, and then it's going to pop back up. Because I think the bullion banks want to be long when that happens, and you can clearly see that positioning happen. And they're making the hedge funds, the managed money, their patsies. And remember, the way they can do that, the gold and silver markets are smaller than the rest of the markets. You can funnel off a lot of losses to the managed money and the precious metals derivative markets, the futures market, without them capitulating, because it's such a small percentage of the portfolio, about 0.5%. However, as the managed money, as gold and silver pop again, and the bullion banks start to make their money, the managed money is going to want to go long. They're going to want to reposition. That's why the bullion banks are going to make most of their money when the market turns. As soon as it turns, they're going to make that initial tranche of money. Everybody else is going to start to pile long as that bull market gets longer in the tooth. The bullion banks have already made their money. Why? They position ahead of time. They move the market ahead of time. This is how they do it. Thanks for the contribution from Dumb Money Media. He says, what you think is going to happen with the VIX? I feel like it's slowly trending down with lower highs and lower lows, Fed rigging. I think the market has seen the initial shock, Conrad, Dumb Money Media, and I believe that it's just moderating right now until the next big thing happens. And so I don't expect the VIX to pop again until you see some really bad news, an expansion of the war over in Eastern Europe, the ECB coming under more visible trouble, Japan coming under more visible trouble, a really bad jobs number. Unemployment drives a lot of things. So you'll see in about 2.5 weeks, the next unemployment number come out, the non-farm payrolls. You know, an official call of a recession coming up at the end of the second quarter, which I think we'll see economists do. I think those are the types of things. And so I don't see VIX spiking right now until we have a big news event. And VIX is a sentiment indicator. It basically tracks news and moves accordingly. So when you have a really bad, nasty news event, VIX goes up. Thank you, everybody, for coming to the program. Dumb Monday Media is here. Peter Farrelline is riding shotgun and doing the moderating. Diana is here. Rolf Steiner, Ralph Potts, Q69, IR Morrison, 999. Niels Hans Dynasty is here. Keller's Cars is here. Thank you for coming in, Keller's Cars. I think you may be in the same neck of the woods I am. Pat BFD is here. Thank you, everybody, for joining the program. Remember, Super Chat's open if you have questions. That is pretty much going to do it for the data I have today. Today was a little bit less data heavy. I've got a lot more for you. However, by the way, I'm tracking something happening with one of the big banks that we're going to report on, and there's a lot more news that we're going to report on, so stay tuned to the channel for that. We've got another roundtable coming up, hopefully to have out this Thursday, that I think you guys will absolutely love. It's going to be a really good roundtable talking about, it's going to be piggybacking off of my and James Turk's a video that we did about a week and a half ago called Gold is Liberty. We're going to talk about liberty in general, how precious metals fits into that, and where we are in this country. And stay tuned to that, because it will have components that talks about investments. It'll have components that talks about quality of life. It'll have components that talks about inflation in the general economy. So we'll talk about all that, but we're going to talk about what is the big picture of freedom and how do we secure it? Is gold and silver a piece of that? And what are the other pieces of that? It's going to be a really good discussion. You guys are going to enjoy it. We'll talk about the metals too on the program. Thank you, Michael, for joining the program. Appreciate you guys. The two of you, Michael and Peter, for doing the moderating duties. We will come back. Don't worry. This is going to be a bit of a short one, but don't worry. It's a powerful one. Just because it's short doesn't mean it's not powerful. It's powerful. What we looked at, the repositioning of bullion banks of the metals is huge. And now's the right time to call that, because they're net long in silver and they've stayed that way for a while. And they're working net long in gold. So now's a good time to start to talk about that trend, start to internalize it and understand how we may take our positions. But remember the OCC report, when I go back to that value at risk, the banks are seeing higher risk, and so they have to reposition so they don't go insolvent, according to Basel III measures. So they're going to be forced to go long, much less they're probably doing it on purpose to reposition for that reset. So we're getting close, guys. We're getting to closer to the bottom of this gold and silver market. We're not there just yet. Technically, yes, on the charts, it can fall a bit more. Right now, I think from a profit perspective, yes, that silver is right now in danger. All the miners are in danger of not making money on their sales, because the average price to get silver out of the ground is about 19 to 20 bucks right now, especially given increases in cost for fuel and labor, and also medical costs and those types of things. So I expect a lot of silver miners right now are not making any money at the current silver price. That will hold back some inventory, like First Majestic did. They'll hold back some inventory from selling and wait for a higher price, but you're going to see some mine projects put off. You're going to see some pressure of the miners here, because silver is now trading in the open market less than what it costs to mine it. And we have a silver deficit every year, to where we have more current demand than we have current supply. So what's going to happen is silver is going to be pulled off the COMEX and ETFs and other repositories. We showed you that in the last live stream. It's going to be pulled off. And then once that becomes very illiquid, that means there's going to be a run on silver, and the price has got to really shoot up. Okay, I think that's why when you look at that, that's why the banks are repositioning in silver. They got to do it when silver's cheap to go net long. They can get those contracts really cheap because they went net short at a higher silver level. So they're making money transitioning out. This is how they do it and make money. Then they're going to go long. And then those dynamics of the market are going to point to where silver price has to come up, or you're not going to have any available silver, and the bullion banks are going to make their money. So I'm putting together previous reports on where the banks are positioned with current data over where we see their derivatives positions and what we see in the mining market and what has to happen for prices. All of this is very, very bullish. And then, of course, we looked at the Fed continuing to tighten, which is a huge piece of it. And we looked at how we're going to have a recession based upon the 10 to 2 Treasury yield curve inversion indicator, which is the single most important and accurate indicator when predicting recessions. So it's very clear we're about to have a recession, a rollover. We're about to have repositioning. Precious metals is going to go long. I fully believe that. I've been talking about that lately, but I think it's a good call. You have some time to get in here and buy some cheap equities if that's what you want to do. I'm not your financial advisor. Make your own decisions. Don't listen to me. But if you wanted to get into the gold and silver equities, now might be a good time to do it, historically speaking, when you look at their valuations for what they really should be. And when you look at the supply-demand factors going on in the real physical market, not the derivative market, but the real physical market, and when you look on what's going on with all the economic fundamentals, I think it's pretty damn clear what's happening. So you want to be with the smart money, which is the bullion banks and the other reportables, the wealthy family offices. You want to be for them and position long in the precious metals, start to go long in the precious metals equities if you believe that that's where they're going. That's what I'm saying. Do your own research. Don't listen to me, but this is what I see, and this is what I think is going to happen. All right, last readout of the poll, 147 votes, 95% of you are agreed. Recession is right around the corner. 5% disagreed. If you disagree, put in the comments below, not the chat comments because we're about to end, but put in the comments below why you think recession is not around the corner, and let's explore that some more in the comments. I welcome you guys go into the comments. Oh, last thing, if you want cheap precious metals, I'm actually going to show this to you on the screen. All you need to do is go to our website and we'll show you how to get inexpensive precious metal cheaper than you'll get anywhere else from a trusted dealer. So just go to goldsilverpros.com. And on our website, goldsilverpros.com, you click on this little button for precious metals deal. It turns white, it takes you down to a form. You click on access deals, and you'll get to a form where if you fill this out with all the information, Ian will get your information. He'll either text you from this number or email you from this number. So whitelist those on your phone in your email client. Ian will reach out to you. He has the lowest margin markup on silver from anybody that I can find at the current time than any of the online dealers. And he also has the lowest markup on gold as well. So if you're interested in the precious metals, what he does is scour 5 different wholesalers for deals. He cuts out all the middlemen. He's able to bring you that product a little bit more cheaply than most other people. So that's where you can get your precious metals deals. If you're interested, reach out to Ian. He's a great guy and a great friend of mine. And we've done plenty of deals. I bought a 1,000-ounce bar right off of the Dakota Exchange, the COMEX approved depository, basically, that Ian facilitated. He facilitated them drop shipping that to me. It was 1,000 ounce. It was like $25,000, $26,000 transaction at the time last year. Went off without a hitch. And I bought silver from him ever since, and he's been great. So personal attestation there. If you're interested, just fill out that form or go to arcsilver.com and contact Ian and mention Gold Silver Pros. It helps the channel. All right, guys, that's going to do it. Thank you guys so very much for joining the program. I think we made a good case here while we're heading to recession. I think it's factual. I think we made a good factual case on how we're about to go long gold and silver. And when I say about, give it a little bit of time for that repositioning to happen. It doesn't happen in a day. It happens in weeks and months, but it's coming. Don't be discouraged if you're in the miners or in the precious metals. Everything that we've shown you the last 3 weeks is basically the classic bull case for a massively huge, gigantic precious metals bulls run. It is coming. It is right around the corner, relatively speaking. Don't worry about that. Don't get discouraged. Thank you, everybody, for joining the program. This has been Gold Silver Pros, July 19th, 2022. Your host, Rob Keents, where we broadcast from the great state of Texas. We take no bullshit. We tell you the truth, and that's why you come here. Thank you, everybody. Until next time.